Good evening. My name is Jackie Knight, and I'd like to welcome you to FTC's educational webinar, Diverse Investments with Self-Directed Retirement Accounts. I'm glad to have you join us this evening, and we will be taking your questions at the end of the webinar. Let me start first by telling you just a little bit about FTC. I do need you to know that we are a retirement plan administrator. We may not and do not provide legal, tax, or investment advice. We also don't represent or sell securities or investments of any kind. We are not a registered investment advisor, and we don't represent or endorse any particular investment opportunities that may be shared in this presentation. And I will be going through some opportunities that are available if you have a self-directed retirement account, but we don't represent or endorse these opportunities. We do recommend that you consult with your legal, tax, and investment advisors prior to making any investments. Now, this evening's webinar is entitled Diverse Investments. So I am going to be talking about some different types of investments, but I am going to start with defining what a self-directed retirement account is. I always assume that I have some listeners that this may be new information to, so I want to give you a definition, and then we're going to talk briefly about short sales, foreclosures, how you could partner with a 1031 exchange property in a self-directed retirement account, tax liens, precious metals, and investing in privately held businesses. I will tell you more about what makes FTC different in the self-directed marketplace, the services that we offer, and then we will have question and answer time at the end. So let's get started right off with a definition. What is a self-directed retirement plan? When we use that terminology, we mean that you hold your retirement account with a custodian administrator that permits you, the account owner, to choose any allowable type of asset, anything that is permitted by law. That would mean you could include what some would consider non-traditional assets like real estate in your retirement account. That is a perfectly acceptable investment in a retirement account. Self-direction also means that you manage your retirement plan's investments. So, for example, if you did hold a piece of real estate in your retirement account and you decided that you wanted to rent that property, you would be the one that would decide the rental rate. You could interview and choose renters. You would decide if you wanted to do improvements to that property, and you would hire the people to do those improvements. You would make the decisions relating to that investment. You manage your retirement plan's investments. So with a self-directed retirement plan, you truly do have control of decisions that affect the value of your investments in those accounts. Now, there are many benefits of self-directing your retirement plan, and the first is that you can truly diversify into a wide variety of assets. Most financial planners and advisors believe that diversification is a good strategy in a financial plan. And with a self-directed account, you can diversify into different types of assets. So you can include non-traditional assets like the real estate that I mentioned. You could also have mortgages in your retirement account or notes. You could loan money to others. You could invest in a private business in your retirement account. Many different types of assets are permitted in retirement accounts. Another benefit, again, you are choosing and you're controlling the decisions relating to those investments. Another big advantage for those who might want to invest in real estate in their retirement account is that you can use leverage in your retirement account to purchase a property. Now, it is actually your retirement account that is getting the loan to buy the property. So it does need to be a specific type of loan. It must be a non-recourse loan. That simply means that the lender, if there is a default on the loan, only has recourse to the property that the loan is on. So it's not a personally guaranteed loan. It's more like a commercial loan, and that is the only kind of lending that is permitted by law if a retirement account is involved. So you can use leverage, but it must be a non-recourse loan. So you can increase the buying power of the dollars in that retirement account by using other people's money and getting loans. Because of all of these things, you may be able to experience a higher return on your investments than you could in an account that restricted you to simply brokerage type assets, stocks, bonds, mutual funds. So diversification, being able to really choose and control those investments and the possibility of using leverage can really give you some good benefits of growing your retirement account. Now, there are many different types of retirement plans. A self-directed plan is not a type of plan. Rather, it means that you are holding your plan with a company that permits self-direction. So some of the more common retirement plans you may have heard of, traditional IRA or Roth IRA, individual retirement account or arrangement. These two types of plans have the same annual contribution limit. In 2016, if you are under the age of 50, you can contribute $5,500 of earned income into either of these plans. If you're 50 years or older, you can add another $1,000 to that and make it $6,500. The difference between these two plans is that the traditional plan, like the majority of other plans, your contributions are pre-tax. So when you make a contribution into a traditional IRA, that amount is excluded from your taxable income for the year of the contribution. With a Roth IRA, your contribution is taxed. With a traditional IRA and other types of plans, when you take distributions after reaching retirement age, those distributions are included in your taxable income in that year, and they are taxed to you. With a Roth IRA, you pay taxes on your contributions as they are made, but when you take distributions at retirement age, the distributions are not included in your taxable income. So with a Roth account, you make contributions annually, for example. You pay taxes on your contributions. Those monies in your Roth IRA account are invested. They are earning. Your Roth IRA value is growing. When you take distributions from that Roth account of your contributions plus the growth, they are not taxable. So a Roth IRA has that non-taxable distribution advantage that other retirement accounts do not have. So something to keep in mind if you're looking for that type of an opportunity in your retirement planning. A SEP account is a simplified employee pension plan. For 2016, the maximum contribution is $53,000. If you are a small business owner or a sole proprietor, you might want to consider a SEP plan as an option for making larger contributions into a retirement plan. A simple plan is another type of plan often used by sole proprietors or small business owners. Partnerships might use this as savings incentive match plan. Again, it allows for larger contributions than a Roth or an IRA. For a simple plan, the contributions for 2016, if you're under 50 years, $12,500. 50 years or older, $15,500. So again, more than you could contribute to a traditional or a Roth. And then I'm bringing out on your screen 4 different types of plans that all say former employer. 401ks are corporate plans. For-profit companies generally have this type of plan for their employees. 403bs, sometimes those are charitable organizations or nonprofit organizations might have 403b plans. TSAs are tax-sheltered annuities, and TSPs are thrift savings plans. Some governments or teachers' unions may have TSAs or government's TSP plans. If you were formerly employed and participated in one of these types of plans, but no longer work for that employer, you can roll those funds out of that plan and move them into a plan such as a traditional IRA, or if you qualify for a SEP or a simple plan, you could move the monies into that kind of a plan, and then you could self-direct those if you wished. Generally, I will say if you are currently employed and participate in one of these plans, you probably cannot self-direct the monies in the plans. You do need to go to the administrator of the plan and find out if you are permitted to move any portion of your funds out of the plan, what that might be, or if you can self-direct, you would need to go to the administrator of your plan with your current employer. Just to give you some ideas of the different types of plans. 401k plans are regular corporate for-profit plans. They also can be self-directed if the corporation decides that they want the plan to be such a plan. So if you currently don't have a plan, a retirement plan, and you would like to make a contribution for 2016, you must have the plan opened by December 31st of 2016 to make a contribution for this year. You will have up to April 15th of 2017 to make that contribution, but the account has to be opened this year. So keep that in mind if you'd like to open a new account. Of course, you can always transfer from a current account into an account with a company with just a new custodian or administrator. So just a little bit about different retirement plans. We do have more information about the retirement plans and the contribution allowances and more details on our website, which is stcira.com. I will also give you that information at the end of the webinar as well. So now that you have just a little bit of information about retirement plans, let's talk about some of these more diverse investments that you could consider for your self-directed retirement account. Now, I will mention that I am personally not an expert in these types of investments. I'm going to give you some general information about them. We did previously do some joint webinars with some folks who do have expertise in these areas, and you can find those webinars on our website. So I will give you some general information, and then that should help you get started with how to go about starting doing your research and your due diligence. So let's start first with short sales and a definition of what a short sale is. I often go to, in the past, have gone to real estate investor association groups, and many folks are interested in short sales and have been for a number of years. A short sale is a sale of real estate in which the lender agrees to accept less than what is owed on that loan to release their lien against the property that secures the loan. And this can come into play when a borrower has some difficulty repaying a loan. Let's say the property value has fallen and it might be below the value of the property itself, so of the amount that's due on the loan. So short sales have come into play since 2008 particularly. This can be a first lien on a home mortgage, or it could be a home equity line of credit lien, and it could also be a lien for a second mortgage. Now, I did a joint webinar with Barbara Clappett of Renaissance Enterprises. She has done a number of short sale transactions herself, so she is very knowledgeable about short sales, and she identified two different ways you could be involved in a short sale opportunity. And one would be to be the bank, your self-directed retirement account, be the bank and make a loan to an individual who is going to do the short sale purchase. In this case, you would actually be a lender, and in this case, you would set the terms on behalf of your retirement account, as the owner of the retirement account, would set the terms with this person who wanted to borrow the money from you to do the short sale. And you would likely want to make the property collateral on this loan that you are making, so that if the loan was not repaid, you could foreclose on it. That would be something that you would determine with the borrower. So your retirement account could be the lender on a short sale property. Alternatively, you could go out and on behalf of your retirement account, purchase a short sale property. So your retirement account becomes the owner of the short sale property. So either of those scenarios is permissible. And Barbara suggested some criteria that she uses in determining if a property is even eligible for her consideration in doing a short sale approach to the bank that has the loan, the lien on the property. First off, the owner of that property and the debtor on the loan cannot make the payments. The owner has no other assets to satisfy the debt. The property value is less than the loan balance. So the bank who holds the lien on that property realizes that, you know, if they foreclose and they sell that property, they're going to get less than is due on the loan. So they already see that they're not going to get the value of the house. And your offer on behalf of your retirement account is equal to or greater than what an auction would provide. So you'll need to do some research to determine what that amount might be. Those are her criteria for determining if she is going to consider a short sale property. Now, to locate properties that might be opportunities, she uses a number of different ways. One is the real estate multiple listing service. So she'll go out and look. They can be labeled short sales. They may also be labeled foreclosures. You can go to the newspaper and look for foreclosure listings, and you can go to the courthouse and look for the pending litigation list. It may be called the lis pendens, and from those documents and those listings, you should see properties that are listed for short sales. Now, I did not actually, I was not able to do that prior to this webinar, to just go out and see what might be available I'm in the Northern Virginia area. STC is located in Hagerstown, Maryland, just to see what might be in those areas. But you can simply do some research and get started on looking for short sale properties that way. Now, similar but a little bit different from short sales are foreclosure properties. A foreclosure actually occurs when an owner is in default on their loan and a notice of default has been filed in the court. Now, in this case, most states have a judiciary website that you can go and search for properties that are in foreclosure. And on those websites, you will see the name of the debtor and the address of the property and the amount of debt that's owed on that mortgage. So you have some starting information there. I have had some folks ask me about pre-foreclosures. Those are more difficult to find. This would be when the owner of the property and the debtor is in default, but they haven't yet received the breach letter from the lender, and so it hasn't been filed in court. So those might be more difficult to find. Oftentimes you can learn about those, from real estate investing colleagues and stuff, or you may have connections of your own that might indicate some properties that are likely going to foreclosure that you could maybe get ahead of the game on those properties. But they aren't officially listed on judiciary websites yet. So locating foreclosure properties, again, that state judiciary website will also list foreclosures. And you can also go directly to the courthouse in the area that you're interested in properties. It is important to consider the jurisdiction that you're looking at purchasing properties in for your retirement account, because different jurisdictions have different rules. So again, you can go to the courthouse in the area that you're interested in looking at properties in, request that pending litigation of active foreclosures. You can also look in newspapers and look for ads of auctions, in which case they might be labeled trustee sales. I did do a little search on that about 3 months ago in my county, and I found 350 auctioneer websites. That's another option. I found 350 auctioneer websites in my county, Fairfax County in Northern Virginia, and when I looked for trustee sales, I found 25 at the moment in time when I looked. So there probably is, a fair amount of opportunity, and you can go out and do your research to start looking for those properties. Now, Ms. Clappett had some things that she really thought were very important. She actually operates in Maryland, where FTC is headquartered, and she wanted to make sure that people who were looking into foreclosures realized that they needed to do some research into the foreclosure laws of the particular state they are looking in. So you want to find out if the state that you're looking in has a foreclosure law. And if it does, are there any restrictions on purchasers of foreclosed properties? You may also want to think about whether or not you may need a real estate attorney who is proficient in foreclosure law to assist you. If you happen to have that expertise, great. But if you don't, it can be complex, and you may want to enlist the aid of somebody who is familiar with the law in the state that you're looking at. You'll also want to find out what the details of the foreclosure process are. And very important, you want to find out if the property owner will have the right of redemption on this property. I believe that in Maryland they do, or they certainly did when I last spoke with Barbara. So that's something to realize, that if your retirement account purchases a foreclosed property, you want to know if the former owner has some rights to redeem that property at some point in time, and what those rights are. So some things to check into. Now, like foreclosures, there are also REO properties. So this would be real estate that's owned by the bank. It's been foreclosed on, it has been taken back by the bank now owns it, and the bank wants to sell it because banks really aren't in the business of holding properties. So real estate owned by bank. You can find these properties by contacting local realtors who have properties listed as bank-owned, and you can also go to the bank's website itself to locate their listings. And I did that a few months ago, just picked a bank and went out to their website, and I saw that they listed the properties, and they would list the agent contact information. So that's a quick way to find the realtors who are working with REO properties. So that will get you started on, if you're interested in short sales or foreclosures or bank-owned properties, some things you want to think about, some research areas you'll need to go to, and how you might start looking for properties in those particular types of investments. Now I'd like to talk a little bit about 1031 exchange property. You may have some familiarity, particularly I oftentimes have real estate investors listening into webinars, and you may be familiar with what 1031 exchange property is, but let me just give you a little bit of a definition. 1031, that number comes from the Internal Revenue Code, Section 1031, and what that section of the code allows is it allows an owner of a property to sell the property and purchase like-kind property with the proceeds of that sale without incurring any immediate tax liability. You may be aware that when you sell investment property, there are capital gain taxes. There can be federal capital gain tax, state capital gain tax, and depreciation recapture tax. And the combination of those three taxes can be 25 to 30% at that rate. So many people who are real estate investors want to defer paying those taxes and will purchase another property with the proceeds of the sale of property. So maybe they purchased the property, it has gained in value, they want to sell that property and realize that gain, but they don't want to pay taxes on it. So they use this section of the IRS code to immediately reinvest those proceeds into another like-kind property and avoid those taxes in the short term. Now, that's a way to avoid immediate taxes on real estate sale. A retirement account already is a tax-deferred entity. A retirement account does not pay taxes, generally speaking, on gains. They're tax-deferred vehicles. The purpose of the retirement account is for you to make contributions to that, invest in assets that will earn income for you that stays in that account and grows until you reach retirement age and need those monies, and then you begin taking them out, and that's when you pay taxes. So by definition, a retirement account is already a tax-deferred entity. So how could you use a retirement account along with the 1031 exchange rules and benefits? Here's an example. And I will mention that I did a joint webinar with James Brennan of Exchange Solutions Group. He's the Managing Director of Exchange Solutions Group in Northern Virginia. So they are experts in 1031 exchanges, and you can get his information from our website by looking at that previously recorded webinar. But he gave, here's an example, and I'll give you some information about the details of 1031 exchanges. Let's say that property A, you decide, you find a good investment property, and you purchase it using some personal funds and some retirement funds. Now, let me just mention here, you may have some information about rules relating to retirement accounts that say that you cannot do, there are some prohibited transactions related to disqualified persons. And you and your retirement account you are a disqualified person to your retirement account. And that is true, you are. But if you personally, with personal funds and your retirement account, co-invest in a property at the inception of a transaction, you can invest together. It does have to be at the inception of the transaction. If you have questions about that, we can discuss that more. STC specializes in a setup that makes that a straightforward process, but you can do that. So if this is an example of, we'll say, one of our clients who has invested some personal funds and some of their retirement funds held at STC into property A. Now, the property A has appreciated in value, and you want to realize that gain both personally and into your retirement account. Let's say you owned it 50-50 and you had a 25% gain on this property, but you don't want to pay taxes on your personal portion. So what you could do is you could sell this property, and the portion of the proceeds, the pro rata share that was owned by the retirement account, let's just say your retirement, it was owned 50-50. 50% of the proceeds of the sale of property A would go into your retirement account, automatically tax deferred because it's a retirement account. The other 50% would go to you personally. You decide you want to reinvest that money using a 1031 exchange to avoid the capital gain and the depreciation recapture tax. So you do a 1031 exchange with the personal fund portion, the 50% that you personally earned on that sale of property A. You can actually do that, but then of course with this personal funds and this 1031 exchange property, you must follow the exchange guidelines. So let me give you a general overview of these. If you would like to talk to an expert in this, again, I would recommend you talk to James Brennan, Exchange Solution Group. You can get his contact information by Googling him or by going to our website and looking at that webinar. First, you must use a qualified intermediary. That is an independent third party, and it cannot be someone who has been your attorney, your accountant, your broker, or your employee during the last 2 years. So has to be an independent third party. And what the qualified intermediary does is they hold the sales proceeds from the sale of property A. They hold that on your behalf in order to avoid what's called constructive receipt by the property owner. You cannot receive the proceeds of that sale personally if you're going to do a 1031 exchange. The proceeds have to be held by a qualified intermediary. You must also identify like kind and eligible property. So property that's held for trade or business use or for the investment by the taxpayer. That is what is like kind eligible property. Let me say that again. Property held for trade or business use or for investment by the taxpayer. So it's usually investment property. There are some things that do not qualify as eligible property. Number one, personal residences. You cannot do this with a personal residence. You can't do a 1031 exchange. You cannot do developed lots that are held primarily for sale. You cannot do property that's to be resold immediately after completion of improvements. So if you are thinking of buying a property, rehabbing it, and flipping it, that does not qualify as a like-kind eligible property. And you cannot do partnership interest and stock. So what you're really looking at is property that's going to be held by as an investment or for trade or business use. Now, you want to avoid taxable boot. That's the whole point of a 1031 exchange. So all of the relinquished property sale proceeds, so all of your portion of the property A proceeds must be used in the purchase of the replacement property. You can't keep out even a small portion of it. You have to use your whole 50% of the proceeds in the new purchase. There are also identification and exchange time periods. You have 45 days to identify a property and 180 days to actually purchase one of those identified properties. So very important to keep that in mind. There are some other items that are important. I'm not going to go into the details of those. I just invite you to watch the webinar on our website and contact Mr. Brennan if you have any more questions. But we certainly have had folks who are very interested in doing this kind of a transaction. You know, it benefits their retirement account because the retirement account now has grown on the portion of their ownership and the gain that was made on that appreciated property that was realized, and they have avoided the tax consequences by reinvesting in a new investment, holding it for appreciation, and then down the road they can either realize that gain and pay the taxes or do a 1031 exchange again. So something to consider if you know you want to co-invest with your retirement account, but then realize appreciation gains but avoid taxes on your personal portion. So 1031 exchanges in conjunction with a self-directed retirement account. Now, I have had a number of folks ask questions about another type of investment, tax liens. So I want to talk a little bit about them. We do have at least more than a few clients who do this type of investment in their retirement account. It's a nice investment if you have a smaller retirement account. If you don't have a large, a large dollar value, tax liens are often much smaller values. And I am going to just stop here a moment because I see a raised hand. And I just want to mention that we do not use the raised hand feature in our webinars because we are recording these and they are recorded. They are posted to our website. So if you have questions, please open up your question box by pressing on the plus sign next to it and typing your question in the box, and I will try to answer those at the end of the webinar. So I apologize, we do not use the raised hand feature. Thank you. So back to tax liens. I did do a joint webinar with an individual named Paul Wojciechowski out in Nebraska. He has done many, many tax lien investments. He runs Real Estate Resource Institute in Omaha. If you're interested in contacting him and getting more information, again, you can get his information on our website. But he gave us some great information about tax liens. So first, let's talk about what is a tax lien. What you are purchasing when you're purchasing a tax lien is you're actually purchasing the right to collect on a delinquent taxpayer's debt. Now, let me kind of explain what that means. Those of us who own property know that we have real estate taxes that we must pay. There are taxing authorities that tax us on our real estate, and that's used to run the government, whether it's a state or a county government. If someone doesn't pay their real estate taxes, then the taxing authority offers a tax certificate or a tax lien for sale for the amount of the taxes that are due. The government needs to get the money to run the government. So if you don't pay your taxes, they're going to sell a lien or a tax certificate in order to get that money. Now, what a tax lien is it's not a tax deed sale. A tax deed sale is where you're actually purchasing the property. And that's not what I'm talking about here. I'm talking about you're purchasing the right to collect the tax. So they might be called tax liens, tax certificates, depending on where you are. What happens is you, the investor, and I'm talking about your self-directed retirement account, could be you personally too, but we're specifically talking about retirement account investing. Your retirement account purchases the right to collect on this debt. They generate high interest rates. Each state is different, and in fact, each county could be different. Florida, for instance, right, is 16%. Some states, well, actually, I'll give those to you on the next slide, but they can generate very high interest rates, and they are senior liens. So what I mean by, and they're also foreclosable liens. So if the certificate isn't redeemed, in other words, if the debtor, the owner of the property that the taxes weren't paid on, if they don't pay the certificate, then you or your retirement account, the owner of the lien, can foreclose on the property and actually become the owner of the property, not just the tax lien. So they are foreclosable liens, and they are senior liens. Tax liens are senior liens. So they can be a very nice investment for your self-directed retirement account, foreclosable and senior. Now, generally, investors purchase tax liens to earn the interest. You earn statutory interest. It's defined by law. It differs from state to state. And in fact, it can differ within a state from county to county. I did a little bit of research within Maryland. It ranges from 6% in some counties all the way up to 24% in other counties. So that is a very nice interest rate, and that's, you know, by law. The last time I checked, Nebraska was 14%, Arizona was 16%, Florida was 18%, Connecticut was 18%. So you can earn a very nice interest rate, and potentially you could take title to the property if the tax certificate is not redeemed. They have a term on them. If they're not paid off in that term, you've earned the interest, plus you can foreclose on the property. Another nice thing about tax liens is they are protected from bankruptcy, so the lien is not forgiven in a bankruptcy. If the owner of that property doesn't redeem the lien and goes bankrupt, this lien still stands. It is not, it is protected from bankruptcy. So potentially a very nice investment. Purchasing tax liens, there are many different processes, bidding processes. Some states have a lottery. Each bidder gets a number. If your number is chosen, you can say if you want to buy that lien or not. If you don't, another number is chosen. They can say if they want to buy it or not. Some states have something called a round robin. You just sit around a table. Whoever is next in line has the choice of purchasing. Every jurisdiction will have statutory bidding requirements. So it is very important that you go to the county treasurer's office and determine what the process in that particular county is for purchasing tax liens there. Now, because the process can be different in every jurisdiction, I have been asked some questions. Well, you know, what if in this county they require proof of funds? So, and that is certainly a very a valid thing. If your retirement account is going to purchase a tax lien, the taxing authority is going to want to know that you have the money to purchase it. So if one of the requirements is proof of funds, FTC will prepare a letter that's emailed to you as an attachment so you can print it or forward it as needed. We simply ask you to tell us the amount that you want listed on that letter of verification, and we can put whatever amount you want up to the full value of your account. You may have a limit on how much you want to pay for a lien, and so you might tell us, no, I only want you to put, you know, $15,000 on my proof of funds, even though I've got $100,000 in my account, because I'm not going to spend more than that for a tax lien. Whatever, you would tell us that. So we can do proof of funds letters. If an entity, a jurisdiction requires a deposit, we can issue a deposit check. It's very simple and straightforward. You would send in a form to us, a request form, and a copy of your advertisement for the tax sale, and we could give you a deposit check for that. We can also do ACHs if the payment, that's automated clearinghouse. The banking system uses that. If the payment must be deducted from an account, then we can set up a zero balance account that we can transfer funds into as you need them for that purchase, and then the money will go directly out to the taxing authority when you purchase that lien. So we can accommodate you, you know, whatever those requirements are, and we have a client services department that deals with all of those details. So what you would do if you're interested in tax liens is go to the county treasurer's office and find out what the process is. You know, get the advertisement when they're going to be at auction or for sale. Call our client services department, email them or fax them the information, and then you will walk through with them the process of what, and we will tell you how we can accommodate that process for you. So every jurisdiction is a little different, so we work with you individually on exactly the requirements that you need to purchase tax liens. Oh, and I just kind of went over some of this information. I apologize. Different requirements, proof of funds, deposits, ACHs. Know your jurisdiction's requirements. And here is a very important point. Purchases must be in the name of your IRA LLC's name. With STC, for each of our clients' accounts, we set up an LLC, and that actually becomes the investing vehicle for your retirement account. So when you are purchasing a tax lien, it will be in the name of your IRA LLC. It's a limited liability company that is set up by our company specifically to be owned by a retirement account. So it's a very specific function, LLC. And the purchases for your tax lien must be titled in the IRA LLC's name. Okay, moving on to another investment that had become pretty popular, you know, in the recent years, precious metals. These can be owned in retirement accounts. Initially, only gold and silver U.S. American Eagle coins were allowed, but in 1998, legislation was enacted that now allows gold, silver, platinum, and palladium bullion it has to meet certain fineness standards. No collectibles are permitted. No collectible coins of any kind are ever permitted to be owned in a retirement account. Investing in precious metals is very straightforward with STC. I can send you a brochure if you are interested in knowing exactly what STC accepts. Gold coin and bullion, silver and platinum. There are a number of different types of coins in each of these categories. American Eagle coins in all three categories, Australian kangaroo, kookaburra, koala coins, Canadian, maple leaf, Mexican. So we have different kinds of coin, and certainly bullion is accepted. So let me just walk you through how you would purchase as a client of STC. Very straightforward. You place an order with the precious metals broker dealer, and you would receive an itemized invoice. You would fax or email that invoice to our client services department along with a form that we give you. It's called a request to transfer funds. That is the form that tells us who you're purchasing them from and the amount that you're paying for it. We will then pay that invoice, and we will receive the precious metal for you. You will not receive them. They will come to STC, and they are stored in a bank safe deposit box. So it goes directly to the bank. This then provides easy access for physical delivery. So you do not take receipt of the precious metals. We don't charge any additional storage fees. That's all included in our wrapped management fee. So your procedures are very simple. Go to the broker, get the invoice, tell us to pay it, and then the broker sends the metals to your account directly with us. Privately held businesses. I have talked to a few folks who are very interested in owning part or all of a business in their retirement account. And you certainly can. You can fund partial or whole ownership of a business. And then a pro rata share, either 100% if you owned it wholly or a portion of the net income would flow into your retirement account. Now, I want to stress something very important here. When your retirement account purchases part or all of a business, it is as an investment. It cannot be as an operation. You cannot work for this business. You cannot take a salary. The IRA owner cannot take a salary from the business. It has to be a passive investment. Otherwise, you would be violating the prohibited transaction disqualified person rules that relate to all retirement accounts. So I just want to say that up front. You can't purchase a portion or all of a business with your retirement account and then work at that business. You also can't have certain family members work at it. Your spouse, your parents, your children, none of those people could work at a business that your IRA had an ownership interest in. So you do want to keep that in mind if you're thinking of this type of an investment. So investing in a privately held business. Now, I did a joint webinar with Jim Eshelman, who is a business broker. He has expertise in this. He has sold a number of businesses personally, and he has helped people sell and buy businesses. Jim Eshelman of Strategic Endeavors in Pennsylvania. You can look him up. You can search the internet, or you can go to our website and listen to that webinar. But he has some very good wisdom if you're interested in this type of an investment. So in evaluating a business, you do want to consider working with a business broker who has expertise. Of course, if you have that expertise, great. You can use that to your advantage in your retirement account. You will be considering the risk versus the reward of the investment. Small privately held companies can generate a very good interest. There is certainly risk involved with that. Smaller companies might have more difficult staying afloat in certain economic environments, so you would want to do your due diligence. What you are purchasing is the future stream of cash flows that that business is going to generate. And to find a business for sale, you could use a business broker, or you could also go to business listing websites and perhaps work directly with the business owner, the person selling the business. What is included in the price depends. Usually it's furniture, fixtures, and equipment. Usually it includes a market rate lease for the actual location of the business, goodwill and intangibles, so the name of the company and the goodwill that's generated by that. Whether or not you purchase inventory is open to negotiation. That's not always clearly a part of most business sales. And sometimes the seller will offer seller financing, so you could potentially use leverage in purchasing part or all of an ownership of a business in your retirement account. Again, you could not personally guarantee that loan. Only the business. It would not need to be a non-recourse loan from that seller. Jim, Mr. Eshelman highly recommended that you seek competent counsel on potential tax consequences if your retirement account is involved. There is the possibility that UBIT, unrelated business income tax, could come into play. And the investment still might be a great investment even if you do have some tax consequence to your retirement account. You just want to consider that. And there could also potentially be a tax consequence at the time of sale, especially if financing was used. Then UBIT could come into play as well. So you do want to check on that prior to investing in a business with your retirement account. Another possibility that is a little bit different would be making a loan to a business owner. Then you wouldn't actually be owning a portion of the business, but you would be a lender to the business owner. Oftentimes, business owners need startup working capital, or they need to fund inventory purchases, and you as the retirement account owner can set terms of the loan. It could be a percentage interest, or it could be a percentage of profit. So very straightforward. If you want to set the terms of the loans, you would be doing that. I want to briefly talk about the benefits of the structure we use. I am just looking at the clock, and I have gone longer than I intended, so I'm going to go through these rather quickly, and I hope you can stay with me to the end. The benefits of our LLC structure is that it does offer you maximum flexibility in structuring your transactions. With a retirement account, you can have multiple parties to the account. You can use leverage. It does provide an additional layer of asset protection. We do offer checkbook control over your retirement funds. We can fund your investments very quickly, usually same day or next business day. It does simplify asset titling, and it does ease pooling or partnering with other sources of income to co-own the investments with your retirement account. This is a little schematic of our retirement plan LLC structure. Here you see your current custodian and the money's moving to our self-custodian. Here is the LLC that we've set up in the state of your choice. Membership interest of the LLC moves to your account with the custodian, and your retirement funds move to a bank account that your LLC has access to. Here you've invested in 2 wholly owned investments, 1 and 2, but number 3, your retirement account is one of 4 investors. And in this case, the other 3 investors are otherwise disqualified persons of your father, your daughter, and some of your personal funds. But as long as this co-investment happened at the inception of the purchase transaction, this is permissible. So our retirement structure does offer you some additional options. We are a full-service administrator. We offer you that LLC structure setup, the protected checkbook control. We have CPAs and attorneys to answer your technical questions. We offer unlimited guidance on transaction compliance. You can call our customer service office and talk as long as necessary to help understand how to structure a transaction, etc. We handle all the back office support for your retirement account. We maintain financial statements for your LLC. We supervise the regulatory reporting, and we oversee the annual valuation. Now, I want to move directly to questions and answers, so let me open up my question box and see if anybody has sent me some questions. I'm going to stay on the line a few minutes, and I see that I have a couple of questions. If you have a question, please do type it in if you haven't already. Okay. What is the time frame to get my account up and running with FTC? Excellent question. We do ask for 4 to 6 weeks from the time we receive your original paperwork to your account completed setup. And the reason for that time frame is we do need to get the funds moved from your current custodian to our custodian. We do need to get the LLC established, and then we do need to get the funds moved from our custodian into that bank account. So there are several phases of the account setup. It may not take that long. Oftentimes we can do it in less time, but if you are already looking for an investment, please get the paperwork in, because these steps just take some time. Once your account setup is complete, then we can offer that same day or next business day funding of your investment. So then you have immediate access to your funds. But initially we do ask for that 4 to 6 weeks for everything to be complete. Okay, this is kind of a follow-up to that question. Once my account setup is complete, what does FTC require from me to purchase an investment? We simply need one of our forms, the request to transfer funds form, along with any supporting documents. If it's a real estate transaction, of course, we would need promissory note, HUD-1, all of those documents that would go along with a real estate transaction. And then we can get started on funding your transaction. Okay, I am really out of time, so I'm going to answer this. I have one more question here. If questions come to mind after I close out, please do feel free to email me. You can find my contact information on our website at ftcira.com, and I will be happy to assist you. Can't I just form a business LLC on my own? I already know how to do that. Actually, no. The LLC that we use is a very specific LLC. Its articles of organization and its operating agreement are designed to be owned by a retirement account. So our attorneys have designed this specifically. We use it with our custodian. They have reviewed and approved it, that it is legit for a retirement account. So that is part of the service that we offer our clients. I want to thank all of you for attending. And I hope you will join us next month for our educational webinar. You can check out our website to see what that's going to be about, and we'll send you an invitation as well. Thank you so much for joining us this evening. Have a great evening. Good night.